And now we've got Jake Klein from Evolution Mining presenting. This is going to be interesting because what we're doing is he's pre-recorded the first component of his presentation, which we'll see up on the screen shortly. And then he's going to stream live for a Q&A when we've finished that and a bit extra. So we'll see how we go. But Jake, he's Executive Chairman of Evolution Mining. He's an accountant by training and has been senior executive in the gold sector for over 20 years. He started his career building gold mines in China, and as founder of Evolution, has more recently he's overseen the growth of one of the country's most successful mining companies to emerge in the past decade. So we will welcome Jake.
Good afternoon. It's great to be at Diggers 2020, albeit virtually. The world is really upside down, because if you had said to me in the 2019 Diggers Forum that I wouldn't be able to attend in person because of a virus, I would have thought you were either crazy or it was a bad joke. Unfortunately, you're not crazy and it's not a bad joke. Over 1 million people have died as a result of this virus. The mining industry is in a fortunate position, and Australia has dealt with it really well. But we shouldn't forget the impact on people's mental health and welfare. And I hope you are well and healthy. But I really do appreciate the opportunity to be able to present, albeit virtually. I wanted to start off by congratulating Northern Star and Saracen on the deal that they had announced last week. It really is a reflection of the great shape the Australian gold industry is in. Right from junior to senior, there are now Australian gold companies that are competing globally and competitively, which is a long distance from where we were 10 years ago, when 75% of Australia's gold production was owned by foreign companies. Evolution happily occupies that globally relevant mid-tier space. It's the area which we believe provides the best returns to shareholders, and I'll explain why in a few minutes. But we are happy to be there as a mid-tier, around $10 billion market cap, 700,000 ounces of production, growing by 17% over the next couple of years, and importantly, costs coming down. Meaning that we are not only one of the lowest cost gold producers globally today, but we are becoming even lower cost. And that's going to be the thrust of this presentation, around quality driving value. It's also why I'm really pleased that we announced our September quarterly results and have got the year off to a really good start. We're ahead of where we wanted to be at budgets. Our costs are in line. Importantly, again, we are making really good cash flow. $125 million of cash flow, or over $120 million of cash flow, free cash flow this quarter, and paid a dividend of $153 million. We paid off some debt, and our net debt is going down even further. A really cash generative business with over $700 per ounce of free cash flow being made. ESG is becoming an increasingly important issue. We've seen it so visibly in the Australian media. We're seeing it as a really at the forefront of major institutional funds, and it is going to become increasingly important to us as mining companies. At Evolution, we've always had a strong focus on sustainability. We believe that while shareholders need to get a really good return, we also need to make sure that the other two really important core constituencies of ours, our people and our communities, also get genuine, sustainable benefit out of our operations. A quick point on the gold price and the gold environment. Last Tuesday, the Australian government announced their budget deficit was going to be at the highest level since World War II. With these major fiscal programs that are being rolled out in response to the COVID pandemic. I think Australia's a leading example of what's going to happen globally. The US seems to be trying to get trillion-dollar packages together. And you can see the US debt levels have increased dramatically. So much so that US debt over the last 20 years has increased from $5.7 trillion to $27 trillion. And it's now 137% of GDP. Really, to me, what's so confronting and informative is the fact that the US dollar has declined relative to the gold price by about 85% over the last 20 years. So I think the environment for gold is undoubtedly really good. I think another thing that's growing and rising and will become increasingly important for investors to consider is the rising political risk environment. There is no doubt that we are at a juncture in global geopolitics, rising geopolitical tensions, rising resource nationalism, and increasing risk to assets managed by companies in emerging market jurisdictions. I think you're seeing evidence of this, and that's really driven the strategy of Evolution to be focused on Tier 1 jurisdictions, politically secure, where rule of law can be relied on, of Australia and Canada. I said we wanted to be a globally relevant mid-tier. I think we're achieving that. We're a good company at the moment. We want to be a great one. We're on that journey. But I also want to just spend a couple of minutes explaining why we believe mid-tiers are the space to be. It's around critical mass. You need critical mass to be able to fund your programs, to be able to fund your developments, to be able to return money to shareholders, to spend money on exploration. And a mid-tier is that space where you can do that, and where the holy grail of the mining industry, discovery, can also make a meaningful difference to your valuation. If you're a senior, you get to the point where your share price is most likely to correlate with the gold price. Discovery, statistically, is more difficult to find ounces that will make an impact to your value. And if you're a junior, you really are always going to be dependent on the capital markets. And that is really why we are so happy to be in that mid-tier space. It's what we set out to be 10 years ago, a globally relevant mid-tier. We think we're in that space, and our continuous drive is to have a small number, a portfolio of high-quality, long-life assets, continuing to seek to improve the quality of the portfolio over time. Because our fundamental belief is that quality drives value. You have to look at things on a per-share basis. Look at our charts on resources per share, reserves per share, and then you also need to look at what is the future profitability likely to be of a company. And the best indication of the future profitability is the quality of the reserves. That's why we have been very conservative in our calculation of our reserves at $1,450 an ounce. We've only, in the last 5 years, increased that by $100 an ounce, or 7%. Because every time you increase your calculated reserve price, you're eroding the future profitability of those ounces. Yes, the gold price could go up, and it could help you with that profitability, but fundamentally, keeping the reserve price low, conservative, is appropriate if you want to protect your margins. Over the last 5 years, you've seen our portfolio changes, shifting to higher quality, longer life assets. We've acquired 4 assets. We've disposed of 3 assets over that time, with a view that we always need to do things that improve the quality of our portfolio and are accretive to our shareholders. There is no point of growing the portfolio without it being accretive to our shareholders, because we are already at that critical mass place where we can afford and fund a very extensive exploration program. We have a great discovery team. We can pay dividends to shareholders, and we can fund our own growth. I mentioned earlier that last quarter we've started the year very well. We continue to have sector-leading cash flow per ounce of production. Last quarter, again, we made over $700 of free cash flow for every ounce we produced, and that is a real driver for us. Over the last 5 years, our production has gone up 71%, but our free cash flow per ounce has gone up 422%. Again, a great indication of the improving quality of our portfolio and that continual focus of margin over volume. Our CFO, Laurie Conway, always says that he never wants our balance sheet to drive our strategy. But our balance sheet needs to be there to support our strategy. And I think that's the position he's put our balance sheet in over a long period of time and where we're in today. It's why we were able to fund Red Lake at short notice on a fully debt-financed basis. Importantly, it also allows us to pay dividends. We've paid 15 consecutive dividends, and again, we have a leading sector dividend per ounce of produced dividends per ounce amount that we're paying, $365 an ounce, and that is really a leading indicator again of what we believe is important, giving our shareholders a return on the money which we're investing on their behalf. I want to now turn to our asset base because I think that's really important to give you a reflection of where we're at and where we're going on these assets. I'm going to touch on our cornerstone assets. We have a portfolio of 6 assets, 5 operating assets, 1 investment in Ernest Henry, an economic interest. But Cal has been such a transformative asset for us. It's probably worth just reflecting before I talk about where we're going to with this asset, but where we came from. When we acquired it in 2015, just 5 years ago, it had a reserve base of 1.6 million ounces. Mining was due to finish in 2020. Processing of low-grade stockpiles were then due to complete in 2024, with the mine closing at that point in time. Today, our ore reserves are 4.4 million ounces. We have a mine life, what we believe is at least 12 years, and we're now starting to fill in the gap and feel confident that this is going to be a 15 to 20-year mine life. We have a very clear pathway for moving the production base from the current 220,000 ounces of production to what we believe will be a sustainable 350,000 ounces of low-cost gold. We've made a number of changes. We've put in a float tails leach plant. We've increased throughput. And I think importantly for the future of Cal and a long-term asset like this, we've built a IWL, integrated waste landform, tailings dam that removes the need for upstream lifts later in the life, but provides a full life of mine solution for that operation. So we're at 220,000 ounces today. We want to go to 350,000 ounces. Well, that's been based off the discovery of this underground GRE46 Delwini lode. It currently has a reserve base of around 800,000 ounces, a resource base of 3 million ounces. We believe we'll add to that reserve base as we infill drilling and we continue to drill and make discoveries. The deposit remains open along strike and at depth. We've started the feasibility study. We completed the pre-feasibility study. We're moving along with a view that this will be a mine that will be developed. We have submitted our applications to the government for regulatory approval. All indications are that this ticks all the boxes that the New South Wales government is looking for. Shovel-ready projects that will create jobs in central New South Wales. It's a brownfield expansion, and we believe to date that with our community consultation and local community support, that this will have strong support from the New South Wales government. We'll be building the underground mine and expect to be able to be producing our first ore from that underground mine about 12 months after we get approvals. The approvals being the one indeterminate step in the process, albeit, as I said, the New South Wales government is saying that they are prepared to accelerate approvals of these type of projects. That will get us on the pathway to 350,000 ounces of long-term sustainable production out of this underground combined with the open pit. But we're not stopping there. we're now also turning our attention to even beyond that, future open pits, future discoveries, and that will be an ongoing story that you'll hear at Cal. Turning to Red Lake, another really transformative acquisition we made in November, announced in November last year. We've now owned the asset for 6 months. A month ago, we announced the fact that we had increased the resources to 11 million ounces. The last published resource was 2.9 million ounces. Really importantly, in the future of the Red Lake operation is this Upper Campbell area, which I point to, of 4.3 million ounces at over 10.5 grams a tonne. That's going to be the next frontier to take this asset from what when we acquired it, we thought it was a 200,000 ounce a year operation at less than $1,000 an ounce, which would require a transformation from where it is today. We've now set our sights on 300 to 500,000 ounces of production, and a large part of that and the momentum is going to come from developing this Upper Campbell area, which we are now working on as to how best to access it. The operation already has a permit for a decline to be developed into that Upper Campbell area, and we're assessing the best ways in which to try and develop that. There's been a lot of change in the last 6 months at the operation. I suppose the most pleasing thing from my perspective has been the fact that the management and people on site have been so receptive to the change. There have been a number of people changes. There have been a significant number of reduction in the workforce. We are changing the way in which the mine operates, going from a highly selective, narrow vein mine to a more bulk tonnage efficient operation. At the moment, the mine is mine constrained, really due to a lack of investment in exploration and development for some time, particularly development. We're getting those meters of development up, and we are looking to make the mine in the next couple of years moving from a mine-constrained operation to a mill-constrained operation. And we're already starting to assess what impact will being a mill-constrained operation have on the future, and how do we debottleneck that? We're thinking about 20% increases to the milling capacity, but that may not be enough once we get into this Upper Campbell area. So getting to 300,000 to 500,000 ounces of production on a long-term sustainable basis is a visible goal for us, and work has already really started commencing on the planning of how to get there. Ernest Henry has been an amazingly productive and great asset for us to own. We acquired it in late 2016. It produces 85,000 to 90,000 ounces of gold. 20,000 tonnes of copper exposure is a byproduct to that. It's produced incredible amounts of cash for us. Already free cash flow of $779 million. We're drilling below the 1200 RL level, which is an extension to the existing reserves. 18,000 meters are being drilled, and Glencore will update the reserves and resources in the March quarter next year when they publish the reserves and resource statements. But show me a mine that produces over $250 million of free cash flow a year, and I'd like to own that one. Moving to the operation we have in the state of Western Australia, Mungari. It's really been a transformation asset, a turnaround. I used to spend a lot of time explaining to investors why Mungari wasn't meeting targets, and it's a real credit to a number of people who hopefully in the room, in the auditorium, listening to this presentation, the management team, the people on the site, who have really transformed Mungari from an asset that was underperforming to one that is now achieving and exceeding its forecasts. It's giving us confidence in the future of the operation, and we now have visibility of 110,000 to 120,000 ounces of production over the next 10 years. But employee turnover has gone down, mill turnover has gone up, productivity has improved, and we're looking to access and monetize these other resources in the area which we own. That's going to be the key to Mungari's future. It's about unlocking the additional material in the Castle Hill area. It's about looking at whether a heap leach could work with some trucking options to the Mungari plant, or a separate plant. And those are things that we're studying at the moment, but with a high degree of confidence that we're building off a very successful turnaround at the operation. It's operating efficiently, and we are feeling confident about the future of Mungari. I'm going to wrap it up there and leave you with my final message that quality drives value, and that's what drives evolution. We believe in a small portfolio of long life, low-cost assets, a culture which energizes and engages people, which gives them the potential to reach their personal and career best, and also leaves a lasting and positive legacy for the community. I finish off with only one last wish, and that's hopefully being there in person at the 2021 Diggers and Dealers Forum. Thank you.
Jake, I'm not sure if you're there yet. I'm looking at myself. I didn't realise that was me.
Michael, can you hear me? I'm here.
Yes, I can, Jake.
Good. I'm proud to be the first non-West Australian presenter.
No, it's excellent that you've beamed in. Much appreciated, and congratulations on the presentation, which all came across extremely well, and on all the value you've been driving from evolution. It's been excellent. I'll start off with the first question, which has come in over the wire. Jake, with the industry facing significant more pressure from ESG issues, has this led to any changes of your ASIC base? Regards, Bill Lester from K2 Asset Management.
Sorry, I didn't get the last part of that question, Michael. It's our asset base?
Yeah, your reserve base, I guess, under the ASIC regulations.
Well, sustainability has been at the forefront of our thinking for a long time. We have upgraded our whole sustainability team. We appointed a Vice President of Sustainability in January this year, Fiona Murford. She's upgrading our team. We are rated A on the MSCI Sustainability Index, which we're very pleased and proud about. But we recognise that this is an ongoing issue for us, and that funds are going to require more and more transparency and information about sustainability. And fundamentally, we're about, as a company, making sure that it's not a poster on the wall, but it actually means something to our community and employees.
Thank you, Jake. Next one, what's a healthy level of exploration expenditure and meters for evolution? That's from Ivan Heron.
So our guidance this year is that we're spending about $90 million on exploration. I think the answer to the question is how much gold is likely to be discovered, because, as I've said to Glenn Masterman, our VP Discovery, give us a program that's going to discover lots of gold, and he has definitely delivered across our portfolio, but particularly at Cal and Red Lake, and we'll provide him the money. But it has to be value-driven. That $80 to $90 million is where we think it's at the moment. But frankly, what we're seeing at Red Lake and at Cal is likely to need that for the sustainable, for the medium term, because there is just a lot of gold there.
Okay, thank you, Jake. Any questions from the auditorium? I'll move on to another one. Can you discuss some of your JV investments and how they shape Evolution's strategy as greenfield or brownfield opportunities? That's regards from Michael in Lockdown, Melbourne.
Michael in Lockdown, Melbourne, thank you for your question. This is Jake from non-lockdown Sydney, but not allowed to into Western Australia. We've put together a strategy of being in greenfield areas. Glenn put that together 3 years ago. It required a commitment to money and a team, and we've done that. We have a number of projects which we describe as greenfield. We've got 4 at the moment in the pipeline, which we're drilling. One of them in Western Australia, Murchison, the Murchison area, where we're funding and farming into a joint venture there. But we are looking for particular styles of deposits, and we do believe that discovery is the best driver of value in the sector. So we're committed to a greenfield program, putting ourselves in prospective ground, funding them, and also providing and supporting with expertise, and hopefully making something that really makes finding something that makes a difference to our shareholders' value.
Thanks, Jake. Now we're going to bring this to a close. I've got one last question for you, and that is from Roger Howe, and he asks, with Evolution now a 10 billion company, are you getting any pressure from instos to join Bill and become a non-executive chairman next year?
Thanks, Roger, for that question. No, not yet. People seem comfortable with my position as executive chair. It's been what I have been since we founded the company in 2011, but there has been no pressure from institutions at this point in time.
Jake, thanks very much for putting the effort in to present today and beaming in from outside. It's worked out well, and it's an excellent story you've got with Evolution, and we're all going to head off and have some lunch now, and I guess it's you've probably still got some work to do.
Thanks, Michael.
We'll wrap it up there.